This is task 10 from the second sample assessment for business tax. Task 10 is about business disposals. So we've got quite a bit of information here. We've got a table to complete. Let's have a look at the requirement. So you need to identify the impact that the disposal of each of the assets described below will have on trading profits or capital gains by dragging the appropriate response into the impact column. Each response can be used more than once. So we're told that David is a sole trader and has always used the accruals basis of accounting. He is selling the business at market value as he wishes to retire. He has made trading profits of 120,000 in his final period. So with the factory then, so we've got a market value of 560,000 and an original cost of 635,000. So what's going to happen here? So there is no tax written down value, so it doesn't look as if we've been claiming any structures or buildings allowance. So we're selling this asset for a price that is below the original cost. Yeah, so it cost 635, we're selling it for 560, and that means we're going to make a loss on this. And because it's relating to an asset, that's going to give us a capital loss. What about the machinery? Well, we can see we've got a tax written down value here. Now, why is that there? Well, because it told us, didn't it, that David has used the accruals basis of accounting, and therefore David's been claiming capital allowances. If David used the cash basis, then we wouldn't be claiming capital allowances. We just write off the expense when we bought the machinery. So in this case then, we're using the accruals basis, so yeah, we do have capital allowances and there is a tax written down value. And then we're selling off the machinery, aren't we? It cost us 360 originally, and it's got a market value of 200,000. So it looks like we're selling this at a loss. But because we're claiming capital allowances, we need to deal with this through our pool. So how does that work? Well, we're selling this asset for 200,000, so the proceeds from the sale would be deducted from our pool. And we can see that our pool is quite small, so that creates a negative number here. And that means effectively, it's recognizing that we've made a profit on that disposal. And therefore, because of that, we're going to have a balancing charge, and that's going to increase our trading profit. Okay, what about the goodwill? So that has no cost, but we're selling it for 500,000. So that's just going to give us a capital gain. And then for our inventory, so this is not a capital item, is it? This is our trading items. So it had a cost of 24,000. We're selling it for 25,000. So that means we're just making a traded profit on that. Okay, and then in part B of the question, so Sasha is disposing of shares in an unquoted private limited company. She has worked for the company for several years. So you need to identify whether the following statements are true or false. So business asset disposal relief is available regardless of the size of Sasha's shareholding. So can we remember everything about business asset disposal relief? Possibly not, so let's have a look at the reference materials. So here's section 8 of the reference materials, and we can see there's a part here about the business asset disposal relief. So we can see it's available to individuals only, so that applies to Sasha. We've got a tax rate of 10%. There is a 1 million lifetime limit. And if you scroll down a little bit further, it tells us that for shares in an individual's personal trading company, and that's the situation we have here, they do need to own at least 5%. So that tells us that the statement is false because there is a requirement for the size of the shareholding. And then the second statement, if Sasha gifts the shares, they will be eligible for gift relief regardless of the size of Sasha's shareholding. So here we are back in the reference materials again, and there is a section on gift relief. And again, this is for individuals only. And notice it says a personal trading company is one where the donor has at least 5%. But that doesn't really matter as long as it's an unquoted trading company. Yeah. So yeah, we've got the two different areas here. We've got a personal trading company where we have at least 5% of the shares, and we have an unquoted trading company where our ownership percentage doesn't matter. So in this case, it tells us at the very beginning, at the top of the screen there, that she's disposing shares in an unquoted private limited company. So yes, so for gift relief, it doesn't really matter how many shares Sasha owns. Okay, let's move on to part C of the question now. Wilf is selling shares in his company. He is the sole shareholder and director and has been for 15 years. He subscribed for the 1,000 shares at £1 each, and a third-party purchaser has offered to buy them for 1.4 million on the 30th of June 2024. Wilf has no other disposals. So we need to calculate the taxable gain for Wilf on the sale of the shares. So the information we have then, we've got proceeds of the 1.4 million. The cost was originally £1,000. But if we have a look at the reference materials, let's also include the annual exempt amount. So we're allowed to deduct £3,000 from any of the capital gains we make to reduce how much we're going to pay. So that's the 1.4 million minus the 1,000 cost and minus the 3,000 annual exempt amount, which gives us a total taxable gain of 1,396,000. Then in part 2, calculate the tax that will be charged on the gain, assuming that Wilf claims all beneficial reliefs. So we looked at the business asset disposal relief just now, and it would make sense to use this one in this case. So it applies to individuals only, and so that applies, doesn't it? Because Wilf is an individual. We're going to tax it at 10%, but there's a lifetime limit of £1 million. So we'll need to apply that now as well. So we worked out, didn't we, that we've got this gain of 1,396,000. So we can split this up into the 1 million, which is going to be taxed at 10%, and the other 396,000 would be taxed at the normal 20% for capital gains. So there'd be a 100,000 tax to pay on the 1 million, and then we've got 79,200 capital gains tax to pay on the remaining 396,000. So that gives us a tax bill in total of 179,200. And finally, in part 3, calculate the after-tax proceeds that Wilf will have from the sale. So we've got the proceeds of the 1.4 million, and then we deduct the 179,200 tax. So that means that Wilf will receive 1,220,800. So that's the after-tax proceeds.